ESG. You've probably heard that acronym thrown around everywhere, right? But what does it actually mean for a business and for its bottom line? Is it all just a corporate buzzword, or is it really changing how companies are valued? Well, in the next few minutes, we're going to demystify ESG for you. We'll show you exactly why it matters and how it's moving from vague promises right onto the actual financial statements.
Okay, to really get this, you have to start here, with this chart, because this is the key to why we're even talking about ESG today. See, if you go back to 1975, a company's value was mostly in things you could touch, factories, equipment, inventory. But today, that is completely flipped on its head. Over 90% of the market value of the biggest companies comes from intangible things, their brand, their reputation, customer trust. And that creates a huge problem for the old way of accounting.
Think of it like this. A traditional financial report is like the speedometer in your car. It's great, it tells you how fast you're going and how far you've been. But it doesn't tell you there's a massive traffic jam a mile ahead, or that your engine is about to overheat, or if you're even heading in the right direction. To see those future risks and opportunities, the things that actually affect all those intangible assets, investors need a totally new dashboard. They need ESG data.
So here's our game plan. We'll start with this whole new definition of value. Then we'll decode what E, S, and G actually mean. We'll take a look at the reporting revolution that's kicking off in Europe, see how sustainability literally shows up on a balance sheet, and then we'll wrap up with the really big questions that are still out there.
All right, first up, this new definition of value. In an economy that's now mostly built on things you can't see or touch, we just need a better way to measure a company's health and its real potential for long-term growth.
And look, this is the crucial point. This isn't just about PR or looking good for the annual report. This is about money. Cold, hard cash. Major investors are now using ESG data to decide where to put billions of dollars. A company's plan for climate risk or how it treats its employees, they see that as a direct signal of how well that company is going to perform in the future.
So, when investors talk about ESG, what are they actually looking for? It's time to break it down and decode the E, the S, and the G.
As you can see right here, ESG is made up of these three interconnected pillars: environmental, social, and governance. Think of them like the three legs of a stool. They all have to work together to give you a complete picture of a company's ability to create value that lasts.
The E is for environmental. This is pretty straightforward. It's all about how a company impacts the planet. We're talking climate change, carbon emissions, how much water it uses, the waste it produces, and the risks here? Oh, they're very real. You could be looking at massive fines, supply chains getting completely wiped out by a hurricane, or customers abandoning you because they find out you've been greenwashing, just pretending to be eco-friendly.
Next up, S is for social. This is all about people. How does a company treat its own employees, its customers, and the communities where it operates? This covers everything from fair labor practices and workplace safety to protecting your data privacy. And if a company messes this up, you're looking at things like major strikes, huge lawsuits over data breaches, and a loss of customer trust that you might never get back.
And finally, G is for governance. Think of this as the company's internal rulebook. Is the leadership ethical? Are there strong anti-corruption policies? Is the company actually being transparent? Because weak governance, well, that's just a recipe for fraud, terrible decision-making, and it's the fastest way to make investors run for the hills.
Okay, so we've got the theory down. But how do you turn these big ideas into actual rules that companies have to follow? Well, that brings us to what's happening in Europe, which is being led by a powerful new set of regulations called the Corporate Sustainability Reporting Directive, or CSRD for short. Now, this is where the story takes a wild turn. The original plan for the CSRD was huge. It was going to apply to about 50,000 companies. But then, just before it was supposed to kick in, bam, the rules were totally rewritten. The size requirements were raised so high that now only the absolute largest companies have to report. And all the smaller and medium-sized ones, they're completely exempt.
Let that sink in for a second. The number of companies required to report was slashed by about 85%. It went from 50,000 all the way down to around 6,000. This massive, last-minute U-turn just goes to show you how politically charged and incredibly volatile this whole field of regulation really is.
But for those big companies that do still have to report, the impact is huge. So let's connect the dots. How do these big, sometimes fuzzy sustainability goals actually show up as cold, hard numbers on a company's financial statements?
Let's start with a question for you. Imagine a company makes a big public promise to slash its carbon emissions. How does a promise like that actually affect the value of the stuff it owns, like its factories and equipment?
And here's the answer. It's a perfect example. All of a sudden, that perfectly good but polluting production line might be a problem. Because of that new emissions goal, you can't use it anymore, or at least not for as long as you planned. So the accountants have to step in and say, hey, this asset has lost value. And they have to record that loss immediately as an expense. It's called an impairment charge, which directly lowers the company's profit for the year.
All right, here's another scenario for you. What happens when a company's new green strategy says it's going to get rid of its old diesel generators way sooner than it originally planned?
Well, the effect on the books is just as direct. Normally, you'd spread the cost of that generator over its full 10-year lifespan. But now, you've decided to retire it in just 5 years. That means you have to cram all the remaining cost into a much shorter time frame. Your annual depreciation expense goes through the roof, which, you guessed it, eats directly into your profits. A strategic promise becomes a very real hit to the bottom line.
So we've seen how ESG works in theory and how it's starting to work in practice. But as that 85% cut in reporters shows us, this whole debate is, well, it's messy, and it is far from over. So let's end with the really big questions that everyone is still grappling with.
First, the big one, competitiveness. Is forcing companies to do all of this extra reporting a giant burden that makes them less competitive on the world stage? Or is it actually a good thing that pushes them to innovate and become leaders in the green economy of the future? You can find smart people arguing passionately on both sides of that one.
Then there's what you could call the data paradox. On one hand, the European Union says it needs massive amounts of data from companies to meet its ambitious climate goals. But on the other hand, it just passed a law that cuts off the data supply from 85% of those companies. So, how exactly is that supposed to work? Can you hit your goals with a massive, self-inflicted data gap?
And that brings us to maybe the biggest question of all, legitimacy. If these incredibly complex and expensive reporting rules can be changed so dramatically at the very last second, how can any business possibly make long-term plans or investments with any confidence? It creates uncertainty, and it leaves everyone wondering, what are the rules going to be tomorrow? Answering that is the real challenge ahead.